Deep Dive with David Stendahl, where we trade without ego, no emotion, no greed, and no opinion. Before we begin tonight's video blog, please read over our trading disclaimer and remember to trade smart and accept the reality that trading futures is risky. This presentation does not provide buy-sell recommendations, and our information is strictly provided for educational purposes only. As always, trade at your own risk and analysis.
Hey, it's David Stendahl with tonight's Deep Dive. It is November 15th, 2017. As you can see from the Deep Dive table, there's a lot of things going on with a number of different markets. The one I want to focus on today is going to be the S&P 500 right up here. The reason I like to look at this one is that it's in a trading range, a little consolidation, despite the fact the market sold off a little bit today. And we have some trends. They're all pointing to the upside, so there's a little bit of a contradiction going on here, and that's really why I want to focus on this. So, as I mentioned, we've got the consolidation, we've got trends up, we've got the technical rating higher, and we've got the seasonal tendencies longer term up, and that's really the impetus to this particular conversation. So this is really a follow-through with the November 9th deep dive that I did on the S&P 500, where we'd had a pivot high form and we expected the market to sell off. Well, since then, the market has sold off. We're going to take a look at the chart here in a second, but you can see that according to the energy level that we've got gold and we got soy meal and we got S&P all in a low energy level, which tells us that the market is in a consolidation. So if we take a look at the daily bars here, we can see that the market did sell off a little bit here today, and there's been a slow, I mean, it's not really been dramatic, but a slow trickle to the downside. We've got no support according to our signal levels, but the target that we'd be looking at would be a match here with the 50-day moving average eventually. Obviously, it's moving higher. The S&P itself is hitting lower, so eventually they're going to interact most likely. We've got the elastic level, which is in no man's land, and we've got the energy level, which is what I was referring to earlier. It's low and in a consolidation. So it's obviously trending lower, at least right now, but it is in a bit of a tight consolidation if you look back over the last few weeks or so. So the reason that I like this is that the systems currently, if I can come back to the site here, are currently short the market, where we've got two systems, a 120-minute system and a 90-minute system, both of which are short, and they've been short, as I mentioned, since the 9th, and they've got a little bit of a profit going on there. So all is good there, but what has me worried and also feeling a little bit better here longer term is the fact that the S&P is on our top 10 list for markets that are accurate. And I'll just explain this chart just a little bit here so you understand what's taking place. Here is the S&P 500. We have this gray line, which is being on top of, or below, I should say, this dark blue line. So the gray represents 4 separate time frames where the market is accurately following its seasonal tendencies. And the 4 time frames are the 5, the 10, the 15, and the 20-year periods. Each one is highly accurate right now, so that's why the gray line is at 4, as opposed to like bean oil where it's got 3. It's kind of hard to see it, but it stops at 3. The dark blue line is the correlation number that we give for the different time frames, and then we take a weighted average of that, and then we can know which markets are accurately following their seasonal tendencies, and that's how we're able to rank the different markets. So let's go ahead and just take a look at the accuracy rating for the S&P 500. Just come to accuracy, that section at least. You click on the market, in this case S&P 500, and I'll go through these kind of quickly, but all you're doing is looking at this gray bar, and you'll see that they're all going to be gray, and if they weren't, then we wouldn't have that time frame in accuracy. So that was the 5, this is the 10, which just popped in, and the 20, and the previous one was the 15. So you can see that according to a lot of these charts, there's just a little more downside. The most pronounced one is the 10-year, where it still has a little more downside pressure here, probably until the around Thanksgiving or so, and then from Thanksgiving you can see the nice surge, and you see a nice surge through the remainder of the year. If you look at the 20 years, we're actually closer to that base, and we should head higher. So what that means is that I'm a little nervous with our short position in the S&P 500, but I do believe when we take a look at the chart here again that it still does have a little more downside, potential. And if the market should really rocket to the downside, really sell off, then obviously the shorts are going to look like geniuses. But I think that for the most part, that it's probably going to continue to trickle down. Eventually, I'm not sure how many days it's going to take, but up until Thanksgiving, shall we say, or thereabouts, coming down and maybe touching the 50-day moving average, and then we would see towards the tail end of the year another surge if we're going to follow traditional seasonal tendencies. A lot of this is banking on Trump and the Republicans trying to get through their tax reform, tax cuts, however you want to phrase it. We'll see as turn out that actually does take place, but I think that's going to be, as most people would understand, is going to be the primary thing that's going to be causing the market to rally to the upside. So we'll see as to whether or not the market is able to go through its normal seasonal tendencies, still trickle down just a little bit, and then theoretically be able to start to rally again. Until that time, the systems, as I mentioned, are short the market. If I can find it here, short with these two short-term systems, 120 and 90-minute bar systems. So they will react when necessary, and they have been reacting quite nicely ever since the 9th when we talked about it in the previous deep dive. So occasionally I'm going to come back to past deep dives just to point out a couple things. The other one you may want to look at is crude oil, given that crude oil has had a nice little sell-off here in the last week or so. So in any event, that is tonight's deep dive. We'll take a look at another market tomorrow, and we'll go from there. Thanks so much.